Welcome to Essentials, MarketRent powered by Clarendon, your data-driven guide to maximizing rental returns. Each week, we'll bring you actionable insights on market trends and strategies for independent landlords. Let's dive into the latest market intelligence that can help you unlock your property's true earning potential.
It really makes you think, doesn't it? All that potential money just sitting there, almost like, loose change under the sofa cushions.
Yeah.
We've been looking at how real estate investors operate, and while it turns out a surprisingly large chunk of rental income, maybe 8 to 15%, might just be uncollected.
And the really interesting part is this isn't necessarily about finding more tenants or buying more buildings.
Yeah, not all.
It seems to come down to something, well, more fundamental. How investors actually set their prices.
Exactly. It's not about expansion right now. It's optimization. Just getting the pricing right for what you already own.
Mm-hmm.
So our aim today is really to understand how shifting away from just instinct and really using data can unlock this hidden revenue. We've been digging into various takes on real estate investing, market analysis, that sort of thing.
Right. The goal is to figure out why this happens. Why are investors, maybe without realizing it, leaving cash on the table?
Yeah.
And, what kind of smarter approach gets better returns without just adding tons more work?
Okay, let's unpack this then. A big theme that kept popping up was this reliance on, well, let's call them intuitive pricing methods.
Yeah.
These common ways people do it that seem okay on the surface, but maybe they're actually quite costly.
That's right. 4 main ones really stood out. First, there's just applying a fixed percentage increase every year. Simple, maybe, but
it totally ignores what the market's actually doing,
Yeah,
right?
right.
And what competitors are charging now.
Exactly. It's like driving using last year's traffic report.
Yeah.
Then there's the quick look at other listings nearby.
The quick scan method.
The problem there is it's just, a snapshot. You see the asking price, maybe not what it rented for.
Yeah.
And you're probably not comparing like feature for feature.
Right. 2 places might look similar online, but one's got a new kitchen, the other hasn't been touched in years.
Precisely. Big difference in actual value. Maybe one has in-unit laundry, the other doesn't. Details matter.
Okay, and method 3, asking other local landlords. Chatting about rates sounds sensible, but...
Yeah. The risk is it can accidentally create this kind of cycle of underpricing.
Oh, interesting.
If everyone in that local network is using maybe flawed methods, they just end up reinforcing each other's, well, potentially low prices. It becomes the norm, even if it's not based on solid market data.
Huh. Which brings us to number 4, the classic gut feeling. Just going with what feels right.
And this is where, our own biases can really mess things up.
How so?
Well, our intuition might be driven by fear of vacancies, maybe, or just wanting things to be simple. So we price more conservatively than the market might actually bear.
So these 4 ways, fixed hikes, quick listing scans, asking peers, gut feel, they all seem to have its potential to, well, underperform financially, and the impact isn't trivial, is it?
Not at all. The material we looked at had this really clear example. Just 5 properties, say $2,000 a month each, using these less data-heavy methods. Those investors could easily be missing out on well over $18,000 a year combined.
$18,000, wow. That's serious money. Could be reinvested or just, profit. Exactly.
Okay, so if intuition isn't the best guide here, what's the better way? This market rent analysis idea sounds more rigorous.
It is. It's definitely a shift away from guesswork, more toward an informed, data-backed strategy. It means using professional tools, market rent calculators, things like that.
Okay.
They're designed to pull in structured data on properties that are truly comparable, not just nearby, but similar in key ways.
Yeah.
They often look at recently leased places too, not just listings.
And it's more than just the rent figure itself, isn't it? It digs into the details of those comps.
Absolutely. The key is making quantitative adjustments. Factoring in the differences. Square footage, bedrooms, bathrooms, specific amenities, parking, laundry, the condition, recent renos.
Right.
All that gets quantified to give a much sharper picture of your property's real rental value. You might find, say, updated bathrooms, get a $50 premium in your specific area, that kind of thing.
And this is where it gets really compelling because the analysis suggests this data approach actually pays off significantly. That's the consistent finding, yes, across different markets, different property types. Investors using systematic market rent analysis, they tend to earn, that 8 to 15% more in rent.
Wow.
And crucially, it doesn't seem to push vacancy rates up much, if at all. If a property is priced correctly based on good data, it still rents reasonably quickly.
That 8-15%, it really
Yeah.
makes you wonder about the psychology. Why are investors potentially leaving that money behind?
Yeah, it's fascinating. The research pointed to three key cognitive biases. First one is called vacancy aversion bias.
Okay, fear of the empty unit.
Exactly. That strong desire to just get someone in can make investors price lower than they need to, just to fill it fast.
Even though the data might show that, well, correctly priced places don't sit empty for that long.
Precisely. Often, the typical time is maybe 10 to 18 days for a well-priced unit, so that fear might be costing unnecessary money every single month.
Okay, bias number 2, confirmation bias when picking comps. I can see this one happening easily.
Oh, definitely. We all tend to look for info that confirms what we already think,
Yeah.
right?
Mm-hmm.
So if an investor kind of feels the rent should be X, they might subconsciously focus on comps listed at or below X.
And ignore the ones listed higher.
Yeah, or dismiss them somehow. Oh, that was an outlier. Or that one must have something special. Even if it's actually a better reflection of the current market, they might focus on stale listings instead of fresh ones that rented fast at a higher price.
Filtering the data to fit the hunch. Okay, and the third one was status quo bias, especially with renewals.
Very common. Landlords are often hesitant to bump the rent significantly for a good tenant who's already in place.
Even if market rates have shot up.
Right. They want to avoid hassle, maybe avoid the tenant pushing back or avoid having to find someone new. So they only do small increases year after year.
And over time, that leads to the property being seriously underpriced compared to the market.
Exactly. It's a gradual drift downwards relative to potential income.
So these biases, they're powerful forces, often pushing prices down. And it sounds like the whole competitive environment is shifting, making this data approach even more important now.
That's a really critical point. Think about institutional investors, the big property management companies.
They're already using this stuff, aren't they?
Oh, absolutely. They have sophisticated tools, analysts. They leverage market rent data constantly to set prices. They're all over it.
Which kind of creates a gap, doesn't it, between them and the independent landlord?
It really does. As investing gets more data-driven, landlords still relying on, let's say, gut feel or just asking around, they risk falling behind. They're basically competing against players with a much clearer, much more precise view of actual market value. And that gap is probably only going to widen.
Okay, so we get the problem. We see the benefits of market rent analysis. How does an investor actually do it? What are the steps to put this systematic approach into action?
Well, the insights we reviewed laid out a few key steps. First, it's about building a structured database, not just bookmarks, but really tracking truly comparable properties.
Getting specific.
Yeah, location, size, features, condition, documenting the details, going beyond just a quick search.
And like we said, it's not just about the rent number itself.
Exactly. Step 2 is making those quantitative adjustments. If a comp has a balcony and yours doesn't, you adjust for that. Renovated kitchen, adjust. Square footage difference, adjust. You need a system for valuing those differences.
Makes sense. And the market changes, right, seasonally.
It does. So step 3 is factoring in those seasonal patterns. Rental demand isn't flat year-round.
No.
Pricing should reflect that. You might get higher rents in peak season, maybe you need to be a bit more competitive off-season. You need to account for that timing.
And lastly, technology must help here. It seems like a lot to track manually.
For sure. Step 4 is leveraging technology. There's software, online platforms, tools designed specifically to help gather market data, run comparisons, make adjustments. It streamlines the whole thing, makes it much more manageable than, say, juggling spreadsheets.
So following these steps, the outcome isn't just pulling a number out of thin air.
Not at all. It's about arriving at a price that's precise, optimized, maximizing your income while still being competitive in the real current market.
Okay, so wrapping this up, it really does seem like there's this significant, often untapped potential for investors. That hidden 15% isn't just some abstract idea.
No, it represents real money.
A tangible income boost many could achieve just by switching from intuition to a more data-focused pricing strategy.
Exactly. It's that transition. Moving away from those traditional, maybe flawed methods and embracing market rent analysis as a more, scientific tool.
This has been incredibly insightful. It really leaves you thinking. For you listening right now, what small shift in your pricing strategy could potentially unlock that hidden 15% for you? Definitely something to mull over. And hey, if you want to dig even deeper and get more concrete, actionable steps on this, make sure you tune in next time. We'll be exploring the 3 essential components of data-driven rental pricing. You really won't want to miss that one.
That wraps up this episode of Essentials, Market Rent powered by Clarendon. For more insights and resources to optimize your rental business, visit marketrent.us. Don't forget to download our free tools and guides designed specifically for independent landlords. Until next time, reminding you that in today's rental market, data-driven decisions lead to better returns. Subscribe wherever you get your podcasts to stay ahead of the market.